Energy prices are surging again, and this time it's not isolated. Oil, gas, and electricity markets are all tightening at once. Brent crude has climbed above $120 per barrel. Gas prices in North America jumped by more than $1 per gallon in just weeks. Jet fuel costs have nearly doubled. Normally, when prices spike this quickly, demand falls and the system begins to stabilize. But this time, the opposite is happening. Prices are still rising and growth is starting to slow. The International Monetary Fund now warns that ongoing disruptions could shave as much as 2% off global growth. So the question is no longer just about energy prices. It's whether the global economy is being pushed towards something more dangerous: stagflation. Stagflation is a rare condition where two things happen simultaneously. The economy slows down, but prices keep rising. In simple terms, it's when growth weakens, but the cost of living continues to climb anyway. That combination is particularly difficult to manage because the usual tools stop working the way they're supposed to. To understand why that risk is rising now, you have to look at how energy actually functions inside the global economy. Energy isn't just another sector, it's a foundational input. It powers transportation, manufacturing, agriculture, and supply chains. Every product, from food to electronics, carries an embedded energy cost, which means when energy prices rise, they don't stay contained, they spread. Higher fuel costs make shipping more expensive. Higher electricity prices increase the cost of production. Fertilizer becomes more expensive, which raises food prices. Airlines pass on fuel costs through ticket prices. The effect cascades across the entire system. In practical terms, energy acts as a baseline cost. When it increases, everything built on top of it becomes more expensive. But the impact doesn't stop at inflation. It also affects growth. As costs rise, businesses face tighter margins. Some reduce production, others delay investment. At the same time, households spend more on essentials like fuel and electricity, leaving less for discretionary purchases. Consumption slows and economic activity begins to weaken. So energy operates through two channels at once. It pushes prices up while pulling growth down. Under normal conditions, markets adjust. Higher prices reduce demand, producers increase supply. Over time, the system stabilizes. But that adjustment mechanism depends on one critical assumption: that the energy system is flexible. Right now, that assumption is breaking down. At the center of it is a geopolitical shock: the closure of the Strait of Hormuz, one of the most critical energy choke points in the world. Almost overnight, roughly 20% of global oil supply and 20% of liquefied natural gas exports were removed from the market. That scale of disruption is unprecedented. The International Energy Agency has described it as the largest energy security threat in history. When supply drops that sharply, prices don't just rise, they surge. But the deeper issue is what happens next, because the system is no longer able to respond the way it used to. Years of underinvestment in fossil fuel production have reduced spare capacity. At the same time, the transition toward renewable energy is still incomplete. Renewable systems are expanding, but they don't yet provide the same level of reliability or scalability needed to fully replace traditional energy sources. So the system is caught in between. Traditional supply is constrained, and new capacity isn't ready to fill the gap. That creates a structural bottleneck, and you can see the effects spreading globally. Countries heavily dependent on Persian Gulf imports are already facing shortages. Pakistan, Indonesia, and the Philippines are reportedly approaching critical fuel deficits. Bangladesh and Sri Lanka have introduced 4-day work weeks to conserve energy. India, facing a 17% drop in liquefied petroleum gas sales, is ramping up coal power just to maintain basic supply. In Europe, the pressure is building again. Energy import bills have surged by 22 billion euros in just over a month. Some regions are down to only 6 weeks of jet fuel reserves. This is now the second major energy shock in 5 years. Even in North America, where production is stronger, the effects are visible. Fuel prices are reaching record levels, and the U.S. Strategic Petroleum Reserve is being drawn down. But with reserves at only about 58% capacity, the buffer is limited. Governments are responding, but mostly through short-term measures. Around 400 million barrels have been released from strategic reserves. Some countries are enforcing remote work policies, lowering speed limits, or capping fuel prices. Others are offering subsidies or energy vouchers to households. These actions can soften the impacts temporarily, but they don't solve the underlying constraint. And that's the critical shift. The energy system is no longer absorbing shocks, it's transmitting them. Instead of stabilizing prices, constraints are keeping them elevated. Instead of encouraging growth, high costs are suppressing it. That combination is exactly what creates stagflation risk. You can already see the early signals in the data. Global growth forecasts are being revised downward. The IMF now expects growth around 3.1%, down from earlier projections of 3.4%. In more severe scenarios, growth could fall as low as 2%. At the same time, inflation is moving in the opposite direction. Global inflation is projected at 4.4%, with some scenarios reaching 6% if energy prices remain above $120 per barrel. A Reuters survey found that 44 of the world's top 50 economies have revised their inflation forecast upward due to prolonged energy disruptions. The OECD expects inflation across the G20 to remain elevated, with the United States alone projected around 4.2%. This divergence, falling growth and rising prices, is the defining signature of stagflation. And it's not just showing up in macro data, it's visible at the consumer level. About 44% of Americans say they're driving less because of high gas prices, while 42% report cutting back on household spending. That pullback in consumption feeds directly into slower economic growth. At the same time, production is being constrained. Factories facing higher input costs are scaling back output. Shortages are emerging in key sectors like fertilizers, petrochemicals, and plastics, materials that sit at the base of global supply chains. So the pressure is building from both sides. Prices remain elevated because energy is constrained. Growth weakens because those higher costs reduce demand and production. And this is where the situation becomes particularly difficult to manage, because the usual policy tools start to conflict with each other. Central banks typically raise interest rates to fight inflation. Higher rates reduce spending and bring prices down. But in this case, the problem isn't demand, it's supply. Monetary policy can slow the economy, but it can't produce energy. That puts policymakers in a bind. The Federal Reserve is expected to hold rates steady or cut only slightly, trying to avoid pushing the economy into recession. The European Central Bank, facing more direct energy exposure, may raise rates again to contain inflation. Meanwhile, the Bank of Canada and the Bank of England are holding their positions, waiting to see whether the shock fades or becomes embedded. There's no clean solution. Every option carries trade-offs, and that's what makes stagflation so challenging. It's not just a combination of problems. It's a situation where solving one problem can worsen the other. But the deeper issue goes beyond current policy decisions, because what's being exposed here is not just a temporary imbalance, it's a structural dependency. Modern economies are built on the assumption that energy will be abundant, reliable, and relatively cheap. That assumption underpins everything, from industrial production to global trade to consumer spending patterns. When that assumption holds, the system functions smoothly. Growth can expand without triggering persistent inflation. But when that assumption weakens, the system starts to behave differently. If energy becomes constrained, prices remain elevated. If prices remain elevated, growth becomes harder to sustain. And if both happen at the same time, the economy loses its ability to self-correct. That's the underlying dynamic driving stagflation risk. It's not just about high prices or slow growth in isolation. It's about the interaction between the two, driven by a system that no longer has the flexibility it once did. Which brings the focus back to the central question. Is the energy crisis pushing the global economy towards stagflation? The answer isn't binary. It's not a guaranteed outcome, but the direction of pressure is becoming clearer. As long as energy remains constrained, inflation is likely to stay elevated. And as long as those costs continue to weigh on consumption and production, growth will remain under pressure. The risk isn't just that stagflation could happen. It's that the conditions making it possible are no longer temporary disruptions. They're becoming embedded in how the global economy operates. And when that happens, the system doesn't just experience shocks, it starts to change. If this changed how you see the link between energy and the global economy, like and subscribe. And if you want to understand what comes next for the global economic system, click the video on your screen.